Good morning. Time for another What's Up with the Market. As per usual, we're going to have a look at the markets, the international markets and the local market, and see what's up with it. Before we do that, I'm going to tell you all that none of this analysis that I do today is used in SPA3 Investor, the mechanical trading system, nor SPA3 Trader. And also, I don't use any of it to make any of the decisions in the public portfolios that are run with real money, the ASX and the US public portfolios. And I don't use any of this analysis to make any decisions in my own personal portfolios. I'm 100% mechanical and use SPA3 Investor for the great majority of my active money. I'm a mechanical trader, have been for decades, and precisely follow the exact same rules that are in our systems for my own personal investing. And I have to tell you that everything we cover here today is general investment advice, which we're licensed to provide. None of it is personal or specific advice that we are covering, and we are obviously using real up-to-date end-of-day prices. Right, as we always do, let's start off with the Dow Jones. And there is a little bit of a divergence, a little bit of difference between the Dow Jones and the other major indices. You'll just see that we've made a new high from this period over here, and I've maintained the Fibonacci here because we haven't yet made a new high in this upswing, this upswing over here. I'll just quickly put the swing chart on. So we're in an upswing here, haven't made a new high yet, which you will see in the other indices. This breakout that I kept here, which I'll remove for the next one, to see which way it resolved. Is it resolved to the downside? In this instance, this downside is a positive. Why? Because I'm measuring it. It's a relative strength comparison against the S&P 500, which is the broader market. And typically when the broader market is outperforming the narrow market of the Dow Jones, that's a risk on. That's a good thing. And that is what's happened here, is the broader market is outperforming just the narrow market of the Dow Jones. So I'm maintaining the Fibonacci. We're in this uptrend. We're in the upper part of the channel. And so far, so good. That's a primary bull market. The S&P 500 has made a new high. So I'll put the swing chart on here, and you'll see that this upswing over here, that there was a new high a couple of trading sessions ago, and that is a good thing. So we are higher highs, higher lows. Good thing. Market in an uptrend on the wider S&P 500, the broader market. Now we'll have a look at an even broader market where we bring the mid caps and the small caps and the S&P 500 equal weighted into it as well, just to try and get some more relativity on this broader market. So everything's good so far. Looking at the cumulative new high, new low, no divergence there. The new 52-week highs versus new 52-week lows rising. That's this gray line here, and making new highs. And you can see, so there's no divergence. We look for divergence in this chart. We also look for divergence on the cumulative advanced decline line on the this is on the New York Stock Exchange. So it's not the S&P 500, but there's 250 stocks that are representative here. And if you really wanted to zoom in, you would say there is a little bit of divergence at the end here, just in the last couple of weeks, where we've seen this drop, the gray line drop, and the index make a new high. A little bit short term, and you're going to start seeing some of that coming in some of the charts we look at. We do have divergence on the number of stocks in the S&P 500 that are above their 150-day simple moving average. There's divergence over here, so we can see that lower highs, higher highs, lower highs, higher highs. So that means that the number of stocks that are above their 150-day moving average are becoming a bit fewer while the index is making new highs. However, that does not guarantee that it's one of the indicators, it's the breadth of market indicator, so it's showing a bit of weakness on the breadth of market. Now, these divergences don't always mean that the market's going to fall. Here's an example of lower highs on the number of stocks above their 150-day moving average in the market. There's divergence, but it went higher there, but eventually it did have a fall over there. It's just some indication of some weakness on the broader market, breadth of market. So bear that in mind before I get to my summary message. Right, going to the US dollar, what we look for here is a falling US dollar. So we do want to see divergence here. Divergence is a good thing. Typically when the US dollar falls, there's a pretty high correlation. When it falls, market rises. S&P 500 rises. And that's what we're seeing at the moment. So that is why I've got this green dotted line here. So when the relative strength comparison between the two is falling, that's good for equities. And there we can see that's the raw relative strength. That's the comparison ratio between the two. So that's been falling for some time. And that is why the smooth index rate of change, the SROC indicator, is falling over here. So here we have a risk on. So we've got the S&P 500 showing that the market's rising, higher highs, higher lows. We've got the breadth of market showing a bit of weakness. And we've now got the US dollar falling relative to stocks, which is a good thing. That's risk on. Now looking at the Russell growth, so looking at growth versus value here, this is also risk on. We can see that the Russell growth index has made a higher high. The Russell value index has made a lower high. And we have risk on over here. So we can see that this relative strength line over here, the raw is rising with the naked eye, which is pushing the smooth index rate of change indicator up. And so that is a risk on. So that is positive. That's backing up the fact that we've got a rising market. However, we come now to discretionary versus consumer staples. You can see that the consumer staples is rising high, and whereas the discretionary is falling, that's pushing the relative strength down, and that is a risk off. So that is a little bit of a negative, if you like. It's not for the case of risk on, and hence we have that red dotted line over there and the SROC falling. Let's have a look at the put-call ratio. See the put-call ratio, for some time we had lower lows happening over here, and then we started going to lower highs. We now have the number of puts slightly outweighing the number of calls it in, which is a bearish sign. That's why we have risk off over here, and that's clashing with what we've seen so far in some of the other data that's coming through. Next, let's go to what interest rates are doing. So this is 10-year Treasury note. And we can see there's a downtrend happening here, bumping off the bottom of this lower channel trend line over here. And you can see with the naked, the relative strength is falling, meaning that equities are outperforming the short 10-year Treasury notes. And there we have risk off, but you can see it's starting to drop. So this indicator might, if interest rates continue lower, not stay low, they're not that low, but continue lower in this downtrend over here. And we see the index continuing to rise. This is the S&P 500 in the bottom chart here. And we see the SROC fall over. That's going to be a case for risk on. Now, a little bit of a discussion about, because we've got the index rising, and we did even have the index rising when the Treasury note, the yield on the Treasury note was rising. There's a little bit of a discrepancy here. So what part of the market is getting most affected by higher interest rates, by inflation effectively? And the story is, as you'll see, comes out here is that technology stocks and some of the larger market cap stocks in the US market, technology stocks, they tend to be, because they've got high cash flows and low debt, they tend to be less affected by a high inflationary environment, whereas the smaller cap stocks seem to be more affected. And is that the reason why we are seeing, as you'll see when I show you the small cap and the mid cap indices, that they are really stalled, but the S&P 500 is continuing to make new highs, as is the Nasdaq. So just a little bit of a sojourn there to position this mixed messages, mixed data that we're getting from the market. Onto the 20-year Treasury bond, opposite to yield direction, that is. And what we should do is see, because typically the market would go slightly in the opposite direction to yield, is we should see bonds and equity prices moving the same direction, and maybe not at the same rate, but certainly in the same direction. And here we are seeing them going in opposite directions for periods of time, as we would have seen so we want to see them rising like that. So at the moment, they are going in the short term, going in the same direction. And so from an equity bond perspective, there's a little bit of mixed message there as well. Market volatility using the VIX is certainly way down at low levels. There's the bigger picture. So this is the lower levels here, and we're way down. So that's positive for stocks, and did break out of let's just go back up there. Did break out of this channel that I had, which is rising. It's now fallen out of that channel and dumped off that lower channel line, and are falling again with the rising market. Onto the Nasdaq, the composite index. There we have the channel line is remaining in the channel. That's a long-term channel going back to, not that long-term, medium-term, I'd say, about October 2022, when we hit the bottom, October, November 2022 there. And let's just zoom in a bit to have a look and see what's happening here. There's a new all-time high and a new all-time high. That's a high close, and then a new all-time high. in the last 2 trading sessions. Risk on. So what does that mean? That means that the CIROC over here is this relative strength line compared to the S&P 500. You can see the naked relative, the raw relative strength line is rising, and that's turned the CIROC up as well. So we're starting to see the NASDAQ composite outperform the S&P 500, which is a risk-on environment. That's good for equities. So that's the case for risk-on. That's the case for equities. That the NASDAQ 100, a similar thing happening over here. And just to point out that let me just go back, is that the NASDAQ composite is not as far above its all-time high. So this black rectangle over here is the all-time high going back to, I think it's August of 2021. And this here is now let me just confirm that, sorry, I haven't looked at it for a while. Yeah, that is in November 2021. And that distance above that all-time high is not as much as what the NASDAQ 100 is. So the NASDAQ 100, the larger cap stocks outperforming the broader NASDAQ composite index. So there's the NASDAQ composite. And it's what that's telling us is that the smaller cap stocks of the whole of the net, because that's 2,200 stocks in the NASDAQ composite, there's only 100 in the NASDAQ 100, obviously, is that the NASDAQ is the broader part of the NASDAQ is starting to catch up. We could even do a relative strength. I might do that next time between the NASDAQ 100 and the NASDAQ composite. We could do that as well. But the point is here is that this is up. New highs, new lows. There's the swing chart. It's in an upswing and made a new high. So this is certainly risk on. Right, now let's start looking at some of the other mixed messages. This is a cumulative new high, new low on the NASDAQ 100, some divergence. So in the NASDAQ 100, we're seeing a rising NASDAQ 100 index, and we're seeing a cumulative new high, new low falling. A little bit of divergence. It's a breadth of market indicator, and it's showing a little bit of a mixed message there. What we're also seeing in the NASDAQ 100 cumulative advanced decline, that is all the stocks, how many advancing versus those declining, is we're seeing some divergence as well. Now, we haven't been able to get much out of this for some time. The last time we had this divergence was going back here to May of 2023, and the divergence didn't work. The market went higher after having this the advanced decline line flattening and the index rising, but then we saw the market go higher. So there's no guarantee that just because there's divergence that the market's going to fall, but it's part of this wide data that we're looking at, all these data points we're looking at as coming into, and that is why it makes it, it comes into people who use this. They have to come up with a decision based on all of this, a subjective decision as to whether they should be putting money into the market or not. And depending on where your notion lies at any given time, whether you're hearing, if you then combine that with other subjective opinionated data like what people are saying and writing as opposed to data points, you might get influenced to say, oh, these negative points are going to mean the market's going to fall. Therefore, I'm going to take my money out of the opportunity. So it's subjective data, right? So I just make that point. That's one of the reasons why I'm a mechanical trader, mechanical investor. But there is divergence over here, and that's part of the mixed messages that are coming out in the market at the moment. Is that some are for and some are against what is as to where the market may go from here. So it's not a raging bull market. Here's another divergence data point, looking at the number of stocks that are above their, what do we got here? Their 150-day simple moving average. This is on the NASDAQ 100. So there was divergence, and we did have a bit of a fall. So market rising, breadth of market indicator falling, and now we're seeing this again as well. So we're seeing the breadth of market indicator falling. There's less of the NASDAQ 100 stocks that are above their 150-day moving average, and the market's going higher. So there's a little bit of, that's part of the risk off message that's coming through. Now looking at the technology sector, so just deep diving a little bit deeper into the technology stocks, which are less affected by inflation, certainly the larger ones, we are seeing the outperformance here. So this is a good thing. This is risk on. So when technology stocks outperform, then what have I got it against? The NASDAQ 100. Then this is new high, new low. So this was the all-time high. Yeah, I've now made it. This is the all-time high. And this is a higher high, going higher and outperforming. So that's risk on. That's the case for risk on. Now, into the Australian market quickly, not advancing as strongly as the S&P 500. This is the relative strength against the S&P 500. And typically when we are outperforming, like this period of time over here, that's typically more negative for equities. But when we're underperforming the S&P 500, that's a good thing. So that is case for risk on. Australian dollar rising because the US dollar is falling. And so that's probably a good thing for equities if the US market is strong. Now let's just quickly go to three other indices I want to look at. This is on the US market. This is the equal weighted index, S&P 500, and you can see not making higher highs and higher lows. So there it's in an upswing. We are in an open trade, if you like, but underperforming the S&P 500. And typically in a raging bull market, you would see the equal weighted index outperforming the S&P 500. Why? Because the smaller cap stocks have just as much weighting in the equal weighted index as the large cap stocks. And when they are doing just as well, if not better, then you'd see this rising. So first indication that the broader market is not as strong as the large cap. So what we'd want to see in a raging bull market is the small and mid caps also performing well. So let's have a look at the mid cap. So yeah, this is a relative strength line between the mid cap and the S&P 500, and you can see that it's falling. And you can certainly see it not advancing by as much. There was a period of time here that it was just a short period of time, but if you go back, it's a while. You're going back to early 2023 is the only period where the mid caps were outperforming. Has made a new all-time high relative to the peak that was achieved back in 2021, and only just above it. This is this black dotted line, but underperforming. So weakness of mid caps relative to large caps. And we see it even more in the small cap. So the small cap index, I'll just zoom out over here, still has not made a new all-time high going back to 2021, which was back here in November 2021. So there it is. There's the gap. So, and there's the underperformance. We got risk off here. This is the relative strength compared to the S&P 500 risk off. So we want to see, and we'll keep an eye, I won't do this every session, but we want to see the mids and the small cap start rising, making new all-time highs and outperforming the S&P 500. Then we have a raging bull market. Until then, it's part of the mixed messages as to where this market may go. So we're not trying to predict, we're just taking the data as we have it at this time, and we're looking to see where the strengths and the weaknesses are in the market. And there's just one more that we'll look at. This is the number of small cap stocks that are above in the S&P 600. That's the SML. So it's 600 stocks in this that are above the 100-day moving simple moving average. You can see this. The index isn't. This is the index price not making any advances, but the number of stocks above the 100-day moving average falling. So there's divergence over there. We want to see this sort of thing happening in the small caps, not happening. Right. So that just on the indices, sum that up quickly. There's mixed messages here. There are the breadth of market indicators and the sentiment indicators are giving us mixed messages. And as you know, all the indices we're looking at from large to mid to small cap and the equal weighted. So what do you do in this situation? Well, you follow your signals. If you're a mechanical investor, trader, then that makes it easy. It's literally a few minutes a day, and you're just not even. And you just follow the signals as they come and do your position sizing correctly, and that takes care of our decisions. But we would like to see, because we are long traders, we trade on the long side, bullish market. We'd like to see all these indicators, breadth market, cumulative breadth of market, and sentiment indicators, and the index indicators that we have, all rising. So we'll keep an eye on those to see when and if that happens. Just quickly to go to commodities, the CRB index is in an uptrend. So commodities broadly up. This is gold. Gold broke out, has had a double top over here. Higher highs, higher lows. There's a lower low, there's a higher. So a little bit of indecision happening in gold at the moment, underperforming equities just in this short period of time over here. And it's a bit of a stall over there. So we'll see what happens and all the factors that are driving gold. Silver still hasn't got to its all-time high, but has certainly outperformed gold in that period of time. A little bit of catch-up happening. The copper got above its all-time high, fell below, big run-up. Sharp run up, you'd expect that fall. I could put a Fibonacci on that, and it does look like it would be. Why don't we just do that quickly while we're here, and we'll see that it's, what are we looking at? 38.2, 38.2 retracement, pretty normal stuff. That's what you'd expect. Sharp fall, sharp run up, sharp fall, and you do want copper to find support there at that right on the all-time high, as well as a 38.2. Oil did fall out of bed a bit over here. It's quite a sharp fall. Looks like it may have found support. They're underperforming equities, as was copper. Onto Bitcoin, we do have an open trade, if you like, just using the Siroc over here, shortish term trading system. I wouldn't say it's a trading system. It hasn't been fully tested, but it does have a relatively high hit rate. The stalled a bit around about these all-time highs. That's that dotted line, all-time highs over here, finding resistance after a big run-up. So we'll see which way this plays out. It is in this channel, this long-term channel that I've got running over here, but we'll wait to see where, if this breaks down at these all-time highs or moves on into another strong uptrend. This period of resolution to work out this area of resistance, given that run-up, could still go on for another month or two quite easily before it resolves which way it's going to go. And as for Ethereum, pretty similar. The run-up, much more gentle retracement and started a bit earlier. And also, but it hasn't got to its all-time highs yet. So it hasn't got that resistance quite at its all-time highs, just slightly below it compared to Bitcoin. Right, what's happening with some of the major metals? This is uranium. This is classic, if you like, consolidation right here on the median line that I've put in here, and just this gentle uptrend. It really does look strong, the uranium chart. The iron ore is found support here around about this between the 100 and 125, 130 seems to be a point that is it's quite happy and content to stick around for some time. I know people kind of have in their head in the newspapers and the media that it's run about $75 to $80. It looks more like it's between 100 and 125. And coal showing some consolidation at this level, also at relatively high levels. Just looking at historically at the coal price. So this right up over here around, and what is this, around about 90 to 140, I think it is. What is that over there? Yeah, no, sorry, around 115 up to about 140. It looks like it's starting to find a base there, if you like. So just to go back, let's go back to the S&P 500. We have to go back to here and to summarize. What is the summary? The summary is that there are mixed messages coming out of this market, and which is probably what happens more than the rest of the time, is that we have mixed messages coming from the market. Seldom do we have every single indicator that we look at going in one direction or the other. We tend to get mixed messages and confusion, and that is why it makes this caper so difficult to do. So I see there aren't any questions here. I seem to have answered them. Message is mixed messages, but it's still risk on, and we should be fully invested. We can't deny the price action that's happening, and we just need to follow the signals and keep our portfolios invested. So until a couple of weeks' time, or it'll be a little bit less than a couple of weeks' time, not next week, the week after, we'll do this again and see where the markets resolve. But just keep on looking for those higher highs and higher lows. You can use a 3-day swing chart if you want, or just use the messages, but it's the indicators. But certainly it is risk on. It is an open trade in the S&P 500, which started all the way back here in November of 2023, and is still a rising market. So we want to have our money in this market. Pleasure done. We'll finish it there. Thanks to your time and attendance. And as always, I wish you consistent, objective, and peaceful active investing.